Can't wait to see the first deal.
Let's begin this real quick. So put your information in that recording progress. Meet everybody. All right. Welcome to Apartment Shark Pool. I'm Corneilous Cannon, and here we are at the Apartment Shark Pool where we get deals funded. First, let's introduce our sharks. First, we have. I'll mute you real quick. Oh wow, this is interesting. I have Jillian. That's you, Jillian. You should be unmuted.
Hello. Hi guys. My name is Jillian Sidoti. I am an investor and I used to practice law, and now I just full-time invest. I'm also a CCIM. So I'm just grateful to be here, and I love hearing about new deals. I love looking at real estate. It's like my thing. So
thank you, Jillian. Next we have George. You there, George?
I am here. Hey, everybody. So my name is George Abreu. I'm with Elevate Commercial Investment Group. I've been doing real estate and investing full-time for about 15 years now. Also own a construction company. Last 5 years, I've been focusing mainly on large multifamily. I've acquired about 5,900 units or so. And looking to get to 10,000 this year. I love numbers. I'm an engineer, or at least my degree says I am. Not that I used it for anything, but I like numbers and looking at deals.
That's it. Thank you, George. Next we have Charles. You there, Charles?
I am here, Cornelius. Thank you. My name is Charles Dobbins. I'm an attorney also. Jillian and I have been partners in the past. We're actually partnering on a deal coming up. My law firm's educational arm is the Multifamily Investing Academy.com. We teach new investors and even seasoned investors how to do the multifamily business the right way. I appreciate George saying he loves numbers. I love numbers too, but I'll give the numbers to George. I'll take the contracts. I love the contracts and figuring out, how the contracts work and how they can be done to protect you. And that's what I do for my students is we use many of my contracts that I've learned from over years how to protect yourself and never lose your earnest money on a bad deal. So that's it.
Outstanding. Next we have Irish Kevin. You there, Irish Kevin?
Irish Kevin is in the house. Hello, Shark Pool Nation. I am Mr. Irish Kevin, not to be confused with Mr. Wonderful. I had a local portfolio that I just was in the process of disposition. Luckily for all of us, right, came about the good old Jobs Act. So without that, we wouldn't be in this game right now. So it's a great game to be in. I'm glad to be a part of it. Like I said, I was an owner-operator for 30 years, and I said, I got to get out of this mess I'm in right now. I want to jump into the syndication business. So I sold my local portfolio and I scaled up. I am now a partner in a KP in 6 syndications, Texas, South Carolina, Florida, and soon to be a couple more. So I just want everybody to know that there's plenty of education out there. We're going to hopefully supply some of it and then grow from there. And I just want to also say, bless our men and women serving in the military all over the world, and God bless America.
Thank you, Howard Kevin. Thank you so much. Now that you know about us, let us know about you. So first question, you're gonna have 3 questions pop on your screen. The first question is to ask you, why did you come to this event? Okay, first question, launch, pose. Ask the question, why did you come to the event? Are you looking for people with deals? Are you looking for people with the capital? Real estate, why are you here? Are you looking for that soulmate? All right. Thank you, sir. Answering. Thank you. It's coming in. All right, here we go. 5, 4, 3, 2, 1. All right, and pose. Let's share results. Let's see what we have here. All right, we got a good percentage of people looking for unrefined capital, right? People look for deals. Some people I'm not sure right here. Got somebody looking for that soulmate. Got a couple this time. All right, stop sharing. Now, next question. Next question is, next question I want to ask you is, how can you help other people? What can you bring to the table? What can you, how can you help other people? If you can help find properties, you can help with the capital, you help secure the loan and capital. Realize actually how you can help. Are you looking, or you can be that soulmate somebody looking for? All right, here we go. All right, 5, 4, 3, 2, 1, and poll and share results. All right, so we have a good amount of people who looking to help. They can help find property. A lot of people can help find deals. A lot of people that's sure how they can help, and also somebody can help get that soulmate. Outstanding. All right, here we go. I got one more question for you as well. Okay. Now the question we want to know the audience, right? Now we're talking about the accreditation. Ask a question to your own will. Would you consider yourself a accredited investor? You're not sure what it is. Yes, no, maybe so. All right. All right, 5, 4, 3, 2, 1. All right, we got more than half the room with credit investors. Outstanding. So let's begin our show. Our first person up, Herve, you ready? Let me make sure I can show your screen. Hold on one second. Hold on one second. Cancel this out real quick. Go ahead, Herve. Unmute yourself. So can you talk? Try unmute yourself. Try it. See what happens.
Okay. Can you hear me now?
I can. And you got your partner unmute yourself as well? Your partner?
Yes, sir.
Outstanding. All right. All right, let's make sure you can share the screen. Cancel mine. All right, so J Dog, you got the timer, J Dog? We got timers today. Can you got timer, J Dog? Hold on a second. Here we go. Go ahead, Jenna.
Yep.
All right.
And you have Herve, you also have a timer too?
I don't have a timer. I guess I can put it on my phone, but
Okay,
good
I'll
deal.
give you a 5-minute. When you have 5 minutes left, I'll let you know.
okay,
Hey,
appreciate it.
Cornelius, do you need us to share our screen, or are you going to share?
No, you have it's all yours. You control.
Sure, I got it.
So how I work, everybody. My apologies. What's gonna happen is what's gonna happen is he's gonna present for 15 minutes. After 15 minutes, the sharks gonna have their way, ask questions to figure out how they can help out with the deal. Then if you got any questions, feel free to put it in the chat and we'll go from there. All right. Go righty. Let's see. Whenever you're ready, go ahead, gentlemen.
All right. Thanks very much, Corneilous. And thanks very much, guys, for having us here today. My name is Herve Francois, DeRosa Group, investment team based here in New Jersey. So we are launching here DC15, a 670-unit 5-property portfolio spread between Winston-Salem, North Carolina, and Lexington, Kentucky. Next page on disclaimer. Please know that this is a 506c offering for accredited investors only. Obviously, all the information here is subject to modification and changes and so on and so forth. This information as well is confidential. Please let us know if you'd like to share it with anyone. But again, a 506c offering. The DeRosa Group, founded 15 years ago with the head of the teams, Matt Faircloth, and his wife, Liz Faircloth of the Invest Her Network. We are a traditional value add focused reposition investment group where we like to go in and excuse me, really like to go ahead and purchase those type C minus properties, reposition them to a B property. And again, been around for 15 years and over 70 million in real estate transactions completed. This is our team here, the management team that makes up DeRosa Group on this specific deal. Like I mentioned, Matt Faircloth, myself, Herve Francois, 22-year career on Wall Street, been investing for about 4 years, have some single families on my own, and have been involved with the DeRosa Group since 2018. Justin Frazier, our asset manager, and my partner Kevin Dean on underwriting and acquisitions on the Zoom meeting with us this evening.
Great, so I can take it from here and just give a quick overview on the deal and get into some details here. So as Herve mentioned, this is a $57.5 million portfolio spread amongst 5 separate properties in 2 states, totaling 670 units. We're really excited about this opportunity for a few reasons that I wanted to highlight here. First of all, we've got 5 properties in 2 separate states, and we've got real built-in diversification, not only from an asset perspective, but also from a market perspective. One of the other strong points in this investment is we actually already have over 1,000 unit portfolio, with most of it actually in Lexington and Winston-Salem. So we're coming into this acquisition having already built over a 700 unit portfolio in Lexington, Kentucky, where we've had a ton of success. And then also we've got over a 500 unit portfolio, now down to 336 units, because we actually just sold a property earlier this week in North Carolina, with 336 units being in Winston-Salem. As for the returns here, high level, you're looking at 2 tranches of equity. The Class A shares are actually already sold out, but we're offering a 9% preferred rate of return with no upside for Class A shares, followed by the bulk of the equity, which is actually Class B shares, which is going to offer a 7% pref and a 70-30 split thereafter. We're targeting roughly a 13 to 16 IRR, a 2.5 to 3x equity multiple, and an 8 to 10% cash on cash over a 10-year hold period. The only other thing I wanted to focus on this slide is just to point out that we do plan on placing bridge debt up front and refinancing roughly around the end of year 3 into longer term fixed rate agency debt. And at that time, we do believe we'll be able to pay off all Class A investors, at which point Class B investors' equity will actually increase, but they'll maintain equity in the deal and continue to cash flow. So I kind of already touched on this a bit, but just from a return standpoint, what you'll see here on the Class B side is, as is typical with most value add deals, in the beginning of the life of the deal, you're going to see a lower cash on cash as we stabilize the property. And then we believe that will scale up over time as we renovate units, add value to the properties within the portfolio, and then actually refinance around year 3. We are conservatively projecting roughly returning all Class A capital and about 27% of the Class B capital. I can tell you that as we've gotten into due diligence, most things have gotten better, which is very rare for us. Usually you find a lot of surprises in due diligence, but it's been pretty incredible. Most of the things have come back positive, and we'll get into sort of where rents have gone on most of this portfolio. And so we do expect to outperform this refinance number. And then other thing I wanted to point out is that we do target 10-year hold periods. I know that's a little bit more rare in this syndication space, but our belief, similar to what Jillian was saying, is, we believe that there potentially are some disruptions to come, and we believe the best way to position ourselves is to, place flexible debt up front with optional extensions where we know we can exceed our debt yield hurdles in order to extend if needed, and then also place longer term debt after the refinance, which should enable us to cash flow and increase value over that loan proceeds that we place at the refinance, which will give us flexibility if we do hit a down period in year 7, 8, 9, or 10. And we can get into that in a little bit more detail to come here. Last thing I wanted to mention is just sort of how we found these properties. So we're actually dealing with 3 different sellers here, which is why we're placing 3 separate loans. The way this worked was actually pretty amazing. We usually underwrite somewhere between 300 to 400 deals a year. That's after they've gone through our filter. And we got the 2 Winston-Salem properties under contract first. And then the following week, I was actually out in Lexington touring 2 properties, Park Vista and Eastland, which we've offered on probably 15 times over the last 2 years. And while I was there, was told that the property across the street may be on the market soon. So we actually ended up walking across the street, knocking on the door, speaking with the leasing agent, and a week later we were under contract. So we decided it made most sense to actually combine all these properties into one portfolio to really offer that built-in diversification across 5 separate properties. And that's sort of how we landed on this structure. Now I will pass it to you, Herve, to talk a little bit about the diversification and sort of the built-in synergies and what we have in our portfolio in these markets.
All right, perfect. Appreciate it. Thank you, Kevin. So as we mentioned earlier, 5 properties across 2 markets. And these, again, markets that we have a lot of familiarity. Kevin mentioned earlier, we've been already investing in Winston-Salem, North Carolina. We've already been investing in Lexington, Kentucky for many years. Over here, these are the 3 properties in aggregate that we'll be owning in Winston-Salem after. It will total about 565 units after this acquisition. One of the things that Kevin and I get asked a lot is, why did you guys go ahead and group these Winston-Salem properties with the Lexington properties, right? And so one of the things we're thinking about on sale is when it comes time to sell, we will group all of our Winston-Salem properties together. We also look at properties in the greater Piedmont Triad, which includes Greensboro and High Point. And then when it comes time to sell our Lexington properties, which will have over close to 1,100 units after this deal is closed, we'll have close to 1,100 units in Lexington. We would group those together for a portfolio sale. So you'll see in some of the slides later on in regards to why we particularly like these markets, why we have decided to invest in these markets overall. These properties are very close to downtown Winston-Salem. Over here, Lexington, Kentucky. So all in, after this deal, we're gonna have 8 properties in Lexington. Again, close to 1,100 units all together in Lexington. We closed on our most recent deal in Lexington, Kentucky back in December. That brought us close to 80 units. Again, a very, very compelling market. What you'll see about the DeRosa Group is that we do not like to go after properties in primary markets. We like secondary markets because we believe there's less competition there, less cap rate compression, just more opportunities overall. Gives us an ability to scale and really develop relationships with property managers and contractors in the area, which is what we've done.
Great. So I'm just going to touch on the financing, and I did see a question if there's a minimum investment. Just wanted to hit that real quick. It is $50,000 for this deal. So how we're structuring this deal, we are going to be placing 3 separate loans at acquisition. So you're going to see one loan crossed covering the 2 properties in Winston-Salem. Similarly, you'll have a cross loan covering the 2 Park Vista and Eastland assets in Lexington. And then Stonebridge Apartments will actually have a separate loan. And you'll see we're at roughly 71% loan to cost at acquisition at varying interest rates, depending primarily on the loan size and then also the location. So you'll see Winston-Salem has better terms than Lexington. And then the plan is to refinance between the months of 18 and 36. We're underwriting for month 36 into longer term fixed rate agency debt. The only thing I wanted to add here is we are going to structure the debt in a way where we have flexible prepay, but we also have a longer term fixed rate term. So really what we're going to do is we're going to do what's called a 10-7, which should allow us to prepay the loan at a lower cost at the end of the hold period, but also lock in a longer term fixed rate if we do need to hold beyond, the 10-year hold period. We don't anticipate that, but of course, we want to just prepare for the worst in that case. And it's not that much more of a cost to get that 3-year open prepay period. Okay, so with that, this is sort of how we see the hold period playing out and just the various phases. So just to hit on this real quick.
You have 5 minutes left.
Thank you for the update. Between years 1 and 3, we're calling the stabilization phase. So that's where we're going in. We're adding a ton of value. We're increasing rents, decreasing expenses, and really repositioning these assets. At the end of that, we'll move into what we call the stabilized phase. That's where we really plan to benefit from the work we put in the first 3 years and really benefit from the strong rent growth and very tight occupancy we've seen in these markets. And then the one thing I want to add here is after we do refinance, one of the other reasons why we're placing the 10-year debt with the 7-year loan term is it'll open us up to multiple supplementals if we do choose to place them. Now, we did not underwrite to including any supplementals, but it is one of those sort of icing on the cake situations where if the properties do continue to increase in value, we have an opportunity to actually return capital to our LPs as we go throughout that hold period, in addition to just that original refinance that we do at the end of year 3. And then of course the exit phase. Just wanted to touch on, we already have a pretty built out portfolio in Lexington and Winston-Salem. We continue to, we believe that we'll continue to acquire assets in these markets, which should result in us continuing to build further economies of scale and synergies. And when it does come time to sell, we will have the ability, we don't need to, it's not required, but we can group assets together, sell them off in bulk, and we should get a compressed cap rate because we're basically giving future buyers the scale and the economies of scale that we've built over a 10-year period. I just wanted to hit on real quick, we are doing a cost segregation. Initial estimates are showing about 41% conservatively, but just wanted to hit on that real quick. And then Herve, I will pass it to you. I guess, do you want to wrap on we only have a couple minutes. Do you want to wrap on the proven track record, or do you want to wrap on the markets?
Yeah, let me just go ahead and wrap on the proven markets, the proven track record here. So, just to let folks know that we have experience in these markets. Because of that, these brokers are coming to us with these deals. We've established relationships. The property manager that's going to be managing our properties in Winston-Salem is the same property manager managing the property that we bought in Winston-Salem in October in 2020. That's already been a double for investor. The property manager managing these properties in Lexington, Kentucky is the same one that we've been using. So a lot of relationships there that actually has given the lender a lot of just kind of feel good, particularly when it comes to lending terms, knowing that we have experience and relationships in the specific markets and things like that. So you see the history here, DC8, Kevin mentioned earlier, that's the first deal of ours, multifamily, that's gone completely full circle. We closed on that trend. We sold that property Thursday last week, a week ago today. So that one was sold at about a 30% IRR for our investors in the initial projections 4 years ago. And that had an original 7-year exit. And we sold it in 4 years. The original projections were for a 16% IRR. We sold it for a 30% IRR, bought it for 6.7, sold it for 16 million just last week. DC9 in Lexington, Kentucky, as well as DC10, that were bought months apart from each other. DC9, we just went through a refi this past December. It's going to free up some cash flow for us to go ahead and continue our renovations so we can push up rents over there. DC10 refinanced summer of last year. So we've already returned a quarter of the capital to investors in that one, 18 months. DC11 is the Gemini portfolio. This was the one Winston-Salem bought in October 2020. We've taken up rents up 6 times in 12 months, from $550 for a 2-bedroom, 1-bath to $920 for that same 2-bedroom, 1-bath in just 12 months, flowing straight to the bottom line. Bought it for $55,000 a door. We got an offer for it in November for $92,000 a door. And then DC12, an acquisition that we made in, I believe, September of last year, also in Lexington, Kentucky. So a lot of depth, a lot of breadth. We got a big team. We got a great team. We're excited about these markets. Folks, you probably never invested in Lexington, Kentucky, and that's a good thing. What we're giving you here is geographic diversification. We know what's going on in Dallas, Atlanta, Charlotte, Phoenix, and so on and so forth. These are secondary markets where you can do just as well, if not better. It's below the radar screen, and that's where you want to be. That's why we're excited to be here, and we want you guys to be all excited with us. So on that, we will leave it there, turn it over to you guys. And again, thank you for the opportunity.
Thank you, man. Thank you so much. Thank you so much. Real quick, let's do this real quick. Now for the audience, okay? First thing first, I got a poll up. How do you rate this deal? See y'all some poll? Yeah. All right. 5, 4, 3, 2, 1. Hey, Irvin, get a chance. Pull a slide. How people how they can reach you? Your slide.
Yeah, sure, Kevin.
You want me to keep this up? Sorry about that.
Yeah, just 4 minutes so people can reach you. So everybody
Right,
I got you.
Thank you.
All right, no problem. All right, so how they rate your deal? Outstanding. Now I have a question for you now as well. My next question to you is, would you invest in this deal? Margaret, it's for you, Margaret. That's all it's your doing. Outstanding. 5, 4, 3, 2, 1. All right, now on to the Sharks. All right, Jillian, are you muted? Go ahead, unmute yourself, Jillian.
Okay. All right. So I'm going to let the gentleman here talk about the deals themselves. And I'm just going to keep my comments to the presentation. When you give an investor presentation, you never want to start with returns. You always start with the story. And there was just too much on the slides. You guys have a good story. You have a great story. The whole thing about diversification, your team, all of those are great stories. And you started off with telling me what the equity split was and the returns are going to be. It wasn't helpful to you at all. As a matter of fact, people were noting in the comments, making comments about the returns in the chat here, and it doesn't help your case. So no pictures of the interiors of the units. No, I can't envision a value add because all I got to see was the outside of 5 different properties in 2 different markets that I know nothing about now because you didn't tell me anything about them. So and I will tell you, I know the DeRosa Group. I know you guys are a good group and I know you do good deals. So you got to start telling a different story because that was not the right way to tell an investment story for an investor. And this is for everybody's education. You always start with the why. Why are we doing this? Then you talk about what you're doing, how you're going to do it. And then bring the investor into envisioning themselves into the opportunity. You get them to invest time and emotion before you're going to get them to invest money. And if you start off with the returns, you're never going to get them to that point because the emotion's all gone. They already know the punchline. They know the conclusion. All right. Thank you.
Hey, Cornelius, I don't know if I stopped sharing or if you did that, but if you need me to reshare it, let me know.
I'm going to need you to reshare it.
Yeah, sorry about that.
That's okay.
How's that?
Sure. I'm waiting. Cornelius, who's up next?
Can't hear you.
It's you, Charles. You hear me?
Oh, no, I didn't hear you. Yeah.
Yes, you're up, Charles.
Okay. Okay, great. So let me run through this. Got a couple of questions. If you could, Kevin, you want to go to page 14 for me.
Sure.
Let me ask you the DeRosa Group. What do you guys anticipate happening with interest rates over your hold period with this deal?
So I may have a different perspective than most people, but I don't think interest rates are going to go up as much as most people think they are. With that, I will say we expanded interest rates 30 basis points per year from acquisition to the refinance in our underwriting. So we're building in an expansion in interest rates before the refinance, and then we're also building in a 10 basis point per year expansion in the cap rate just to be conservative. My personal opinion is I don't think that cap rates are going to go up that much. I think that the flow of funds in a multifamily real estate will persist for many years to come, regardless of interest rates. And I also don't think the government can raise interest rates as much as people think they can. So nonetheless, we're underwriting, assuming rates will go up and cap rates will go up. Herve, I don't know if you want to add anything to that.
Okay, but I was going to tell you to add on in regards to, you made some interesting comments to us earlier this week with your background, formerly being at where you used to work, in regards to what they used to do in regards to spread tightening, knowing that the capital has to go out with your former experience at Fannie.
Sure. Yeah, I can add some context to that comment. I worked at Fannie Mae on the pricing desk for 4 years. And one of the things that Fannie does and Freddie and really most lenders is when there is an expansion in interest rates, if there's not a major credit collapse, they usually tighten their credit spreads to offset that increase. The federal government mandates that Fannie Mae and Freddie Mac continue to lend money on multifamily real estate. And they've had extremely profitable years over the last couple of years because they've been able to expand their spreads 50, 60 basis points from where they were prior to with the drop in treasury. And the result has been very, very profitable years and very high spreads. And my personal belief is that if 10-year treasury goes up 30, 50 basis points, their spreads will come down 20, 30. So while there is a high likelihood that the 10-year treasury will continue to go up like we've seen over the last 3 weeks or so, I think that there's more cushion than people think, because Fannie is still able to be very profitable. Same with Freddie, at way lower spreads than they're at right now. And I think they'll compensate to keep flow coming into their space.
All right, let me just ask two more questions and a comment. First off, I like, obviously you're underwriting very conservatively with the value add that you're, showing the reduction in the vacancy during that time. That's one thing you very rarely see some people do, and they think their income is always going to go up on a value add. So I like that. I like this 10-7 idea, especially in light of, I think you're wrong with the interest rates. I think interest rates can't, and the government has gone up in the past. And I'll give you my personal experience with it, and you might find it very interesting. But that 10-7 is actually a really good idea, especially if we do experience higher interest rates. Gives you a longer hold period, which, as we're seeing, that some of these investors are thinking that the smart money is wanting to keep it in the real estate, especially inflation starts to take off. That's a very good thing. One question is on page 14. If you look down there, I'm just curious. You have the scale allows for lower operating expenses. Okay, fine. Favorable financing terms, which results in a lower exit cap rate for whoever you sell it to. I don't understand how can your financing affect the sale cap rate?
Yes. So I think that doesn't read as well as we had hoped. The lower operating expenses should result in a lower exit cap rate on sale. And really the idea there is, if we build scale in the market and we can sell 3 properties at once rather than 1, they'll be able to get the same, shared payroll, lower operating expenses across the portfolio that we have, resulting in potentially a lower cap rate. But we don't think that the favorable financing term will result in a lower cap rate. That was
Okay. Thank you.
Yeah.
That's what I want to hear you say. Now what's the basis for Preakness, the cost basis, or the price you're going to charge our syndication for Preakness that you purchased for 7.7? How much are you paying yourself off of that sale?
So we have not sold Preakness. We refinanced Preakness.
No, but you bought it in 2019.
Yes.
At 7.7.
That's right.
Now you're going to roll over the ownership of the property into our syndication.
No, that's a good question. Thank you for clarifying. We will not be doing that. No, that track record document was just the assets that we've previously purchased. These are separate syndications that are going, and they will not, be touched by the investors in this portfolio. We were just highlighting that Preakness has experienced, a great growth since we've owned the property, but we're not rolling that into this investment.
So you're not putting I thought that would be one of the Lexington assets that you were putting in there.
Oh, you're talking about at sale? When we eventually sell these 3 properties that we're purchasing within DC 15?
No. What I'm talking about is, if I put money into your deal,
yes.
Am I getting an interest?
Oh, I see. No.
In Preakness.
This is not a fund. This is a portfolio syndication. So if you invest in this deal, it's not a fund. It is simply, you're not investing in a concept like you would be with a fund. You're actually investing in these 5 assets right here, just these 5.
Okay, so, but the one I see you're calling it, so Stonebridge is not Preakness, even though the property, because you showed a picture of Preakness.
They look similar. They're not the same. No.
No, but you did have a sign for Preakness on this thing.
Right. It's in the track record. This is.
It was at the beginning. I think I saw it near the beginning. That's Preakness right there.
Which one?
The one that you just had your cursor on.
DC 10.
With the beautiful mansard roof.
Yeah, this was us just showing the track, who the DeRosa Group is. So we highlighted different assets that we own.
Okay. All right. So I'm not getting, okay, that's fine. But let me just tell you something, and I'm going to close with this, Kevin. You talk about, interest rates, or what Fannie and Freddie does.
Yep.
I purchased a 222 unit apartment complex in Lexington, Kentucky, 1 month before Fannie and Freddie filed for bankruptcy.
Was it?
And
Was it Preakness?
it was Preakness.
It was
I used to
Preakness.
own that. I used to own that property.
Okay.
No way. That's amazing.
Yeah, it's very, when you said Lexington, and then I looked at this picture, it's like, holy cow. And then we saw Preakness, I'm like, I used to own that property. And yeah, so that
How long
was,
ago? How long ago?
oh, it was 2008.
Okay.
We bought it a month before Fannie and Freddie tanked. And we struggled with that property for 5 years, and then ended up having to give it back to the bank. I'm looking at the sale on it, the history of it on it, and you know, the guy who you guys bought it from did pretty damn well.
Yeah.
He did amazing. We looked
yeah,
at the
he
price
did.
he sold it to us for, and we felt bad about the price we paid. Yeah.
I feel bad about the price.
That is amazing. I'm so
Wow.
happy to hear that you owned it. Our team is
I
going to love
did.
that story.
I did, yeah. So listen, I love Lexington. I hated the government. We got screwed over by the government. They put a known arsonist in a halfway house down the street, and we had more people move out because of arson, and the city government never helped us out, and they knew that they had placed an arsonist in a halfway house right around the corner, and it just devastated our occupancy. And then one final thing, just so everybody understands, this is an all bills paid property, and so we were paying the water and sewer, and all of a sudden we start getting a new bill from a new German company that pay the water and the sewer in Lexington. And because the town had sold the water and sewer to a third party, and then killed our NOI overnight. We couldn't make ends meet. And then 6 months later, I read in the Wall Street Journal in the op-ed section, the mayor of Lexington boasting about how he was able to balance the unfunded liability of his employees using the sale of the water and sewer to a German concern, which cost me my business. So I have no love lost left for Lexington. I loved Keeneland, but I'll leave it at that. So
Thank you, Charles.
yep.
George, you ready?
Yeah, can I make a request? Can we put a timer when Charles is speaking?
Indeed.
Hey, I had to.
J Dog, what happened, J Dog?
All right. I'll make this quick, and I'm just messing with you, Charles. It's always good feedback that you're giving. So one, I'm good friends with Matt and Justin. I love seeing the team growing. So happy to see that. I think presentation wise, I think Jillian had some good points. I agree. Presentation could have been a little better. Definitely more pictures of the properties. And definitely telling the story first. That's pretty important. The main question I had was on the returns. So why the variancy? What is the 13 to 16? You might have said that and I missed it, but
Yeah, we typically give a range just because usually when we go under contract, we have a specific IRR and then it changes so much in due diligence. So our last 4 or so deals, we've offered a range.
sure, I do the same. I give a range. It's just usually the range is a little tighter, but fair enough.
Talk about how it's gotten even tighter. It's closer to 16% now because, as Kevin was saying earlier, during DD, we found out payroll at our Winston-Salem property is much lower than expected by like $50,000, things like that. So that's bumping up the IRR and the cash flow on some of these now.
And I think, George, you keep it like you say, like 15 to 16. You won't say 13 to 16. Got it.
Sure.
Is it usually 1%? Is that what you'd recommend?
Usually, I think so. And then, are we going off a 10-year or a 7-year hold? What are the terms? It's a 10-year. So I mean, I don't know if this is. It may just be your underwriting's pretty conservative, but you know, if we're leaning towards a 2.5 equity multiple on a 10-year, you know, on a 5-year, that would be a 1.25. That's pretty weak returns.
It was a 281 before we started. Now it's closer to a 3. So we offered a pretty wide range. We should probably tighten that up as well, to your point.
Yeah. Honestly, I'm not sure a lot of people would catch on to that with you're not used to seeing a 10-year hold, but yeah, I had a couple more things here. No, track record you ended up covering. This goes kind of back to the returns. You know, I get the secondary market. I own a lot of properties in secondary markets, but usually we're chasing a higher yield, and that's why we're going there. And just here, the returns seemed a little lower than I'd like to see, but that could do a lot with the underwriting, and hopefully you guys are being conservative there.
Right. That's the goal. We try to underpromise and overdeliver, and maybe we're a bit too conservative in how we presented it, but yeah, typically that's how we do it.
Awesome. No, I know you guys do a good job, and keep at it.
Thank you, George.
Outstanding, gentlemen. You all got some questions in the comments, so y'all get that. Pedro, you up next. Are you ready? So one last time, Herve, give a quick slide information on how people reach out to you. Put it in the chat. Feel free to do that as well, and we can go for our next presenter.
Appreciate it. Thank you.
Thank you all. Thank y'all both, gentlemen.
All right. Thanks, guys.
No problem. Now, here we are again. Now, if you want to share your information, I'll put the Google link in as well. So feel free to connect with each other as we grow together. I'll put it in as well, and I'll send an email out with their information as well, so you can reach out to Herve and Kevin when you're ready. Pedro, you ready, Pedro? Hold on, you should be able to unmute yourself. Pedro, you there? Can you unmute yourself?
Yep, I'm ready. Good to go.
Outstanding.
All right, you want me to start?
Jenna, you ready, Jenna?
You can't hear him, can you hear him? I can't hear him now. You can't hear him either?
No. I can hear you, Pedro. I can hear you, Pedro.
Yeah, I can hear you now. Okay, good. So you want me to start?
Yeah, great. We can see you. Go ahead.
All righty. So appreciate the opportunity to be on the Shark Pool show here today, and made a lot of updates here after Irish Kevin here helped me. Gave me a few points. So we've adapted. So we have the station's a 324 unit multifamily ground up development that we are doing in Kissimmee, Florida, Osceola County. The specific site, and we'll go through the benefits. What is it? It's located right by the Sunrail station. And a big reason why is in the area, there hasn't been Class A multifamily residents, and a lot of folks have to drive quite a ways due to immense traffic in order to go to a decent rentable living house, which would be like no traffic, 20 minutes from here with traffic an hour. So we felt that this is an opportunity to bring Class A to market to the residents in the area. So going through the team, and these are some of the renderings that we're concepts we're planning to have. Our team, from Engel Volkers, we have Stuart Siegel, who was the CEO of Sotheby's for 18 years and has been now running development services and developing in 5 continents. Christopher Steele's our chief analyst, a recent graduate of MIT. Then we have myself. I started in the as a municipal bond trader for JP Morgan, and then as a investment manager with the firm. I have a degree from Pennsylvania State University and some certificates from Cornell. Pete Sackle is one of the managing partners. He was a senior vice president with the Freeman Companies, one of the largest development companies in the world. Dr. Hamilton's another partner and Director of Research and Investment Analysis locally. Dr. Hamilton is a recent retired Army colonel and still consults significantly for through the White House in Virginia. Marcus Fowler is the Director of Investment Services and he's a fully licensed investment advisor. Has been 25 years in the industry. Now, we are co-developing this asset with GFI Capital Resources Group based out of New York. They are an institutional developer and have done over $2 billion in development. The executive team, you have Alan Gross, who's the chairman, and they currently have over 10,000 units in 6 states. And he was added to the Commercial Observer's Power 100 list. Mr. Brass is the general counsel for the firm. Joe Rosen is more on the hospitality side with 40 years of experience. Mr. Spiegelman is on the development side. Eric Bass, also in the development of hotels, and Andy, who is primarily running the development and asset management. So as far as experience from GFI, these are some of the projects they're working on in South Florida. Some hotels that they've developed or redeveloped. These are mixed-use developments that are under construction here in Naples. This is a 270 unit Class A. You have the Ritz, they're doing also the Ritz-Carlton residences right now under construction. They're finishing up and their projected IRR is 48%. The Liberty Parkway is another one that is active and was just sold at a 24% internal rate of return. Copper Ridge, Kansas City, another apartment that was delivered, 24% internal rate of return. And Rivermark West realized as well with a 27% internal rate of return. So why Osceola County? Well, for us, Florida, as we know, is one of the strongest markets as far as residents moving in. Right now, there's close to 1,000 residents who move a day. Obviously, given the strong benefits of not having state tax. There's been a significant amount of infrastructure investment, $15 billion at this time. I-4 is a recent investment that's about to be finished. It's the most expensive interstate project in US history. Orlando International Airport and the Sunrail rail system. That's a major development as well. Now in Osceola County, where we're at, it's the 7th fastest growing county in the US. It is really good pro-development in the area that we are at directly. Population's 82,000, average household income 71,000, which is significantly above the market. 40% is rent or occupied. This has a kind of where the Sunrail line lies. Our project is right on the Sunrail. It's walkable. And the benefits there, Frito-Lay is doing a $180 million expansion, adding 200 jobs. The whole area is above average paying wages. In Florida, the minimum wage is $8. And here the minimum pay starts at $18, average is $20. So you have Frito-Lay that's making a mega fulfillment center. PepsiCo as well is expanding into doing a $40 million expansion. McLean, the second largest logistical company in the country, is making a $20 million expansion. The Lowe's, largest Southeast distribution center, also opened recently. Amazon factories in the area as well. 500,000 square foot industrial sites coming up as well. There's a lot of growth in the area. Again, major employers close. McLean, PepsiCo, Frito-Lay's, Lowe's, and they're all paying average about $20 an hour, which is significantly above where we're at. Now, in addition to those expansions across the street from us, right now in current developments, 57-acre commercial retail park. Publix is going to be the anchor. Most national tenants will be there. Neo City, it will be connected to the Sunrail station. Neo City is a big project for Osceola County. That's going to provide about $25 to $28 billion in economic impact, high paying wages, average salary $85,000. Korean tech giant DS Semicon just signed an agreement to be the master developer and investing $1.2 billion into the project. Medical City, average pay for nurses, 68,000, medical doctors, 250. That's in the area as well. Sunrail Station, which is a big reason why we're there. Anytime a Sunrail Station has opened, they've provided about $1.2 billion in economic impact to the area, and major growth and development has occurred, which is exactly what's happening to our site. Our site has been the Sunrail open for 2 years, and it's the second most used Sunrail in the system, because a lot of folks that work in Point Siena drive to the Sunrail, and they work at many of the hospitals across the Sunrail line. So the demand for our product, currently there's about 5,000 jobs, expected to be 50,284 within the next 5 years or so. Now, as far as the market conditions in Osceola County, vacancy rate, it's at 0.9%. Historical average is 5.5. We don't have any direct competition within an 8-mile radius. There's no units that are expected to be delivered in the next 12 months. Rent growth has grown 16.2%.
9 o'clock.
And as far as Osceola County, it's one of the leading performers in multifamily in the country. And it's projected again to rents to continue to increase and no deliveries in our competitive sector. So as far as investor level returns, we did an assumption from 4 to 6. Now the cap rate where we're basing our numbers is 5%. The comparables in the area are about 3.5 to 3.8. So we believe we're pretty conservative in relation to the market. And of course, increased interest rates and inflation, although we believe that we're in the perfect asset class to take advantage of inflation. But we expect a 5% cap rate sale, which would provide a 47.18 internal rate of return, 4.25 equity multiple. But of course, even if we go to 6 cap rate, that'll still provide 31% internal rate of return and 2.73 equity multiple for investors. So we don't see it going from 3 to 5 to 6% within 3 to 5 years. So we plan to exit, but you never know. Now, example of an investor, this is direct to investors at a 5% cap rate exit. Minimum investment's 100,000. Investors would earn 38.99 internal rate of return, 3.34 equity multiple, and our project yield on cost is 6.57, which is definitely above where we need to be. Limited partners as a whole are investing. They're investing $6.2 million, and they're expected to get a distribution of once at exit $20 million. First distribution starts in 2 years after the project goes live in November 2024.
You have 5 minutes left.
Thank you. As far as an investor that puts in $250,000 as an example, their total distribution would be $832,000, providing a 38.99% internal rate of return, 3.34 multiple. And these are all pictures of the potential subject development. This is a map of the area. Our site is a gray building that is going to be adjacent to a 25-acre community park that's going to be developed with basketball courts, tennis, pools. So it's going to be very impressive. Right beside our site. To the left of our site, you're going to have an 82-acre mixed-use live, work, play community that's being developed by Osceola County in conjunction with us. So that limits any competition, as we will not allow another multifamily project to be developed. Frito-Lay expansion is down there, Sunrail Station. So you can see everything, all the high-paying wages are close to us. We expect to have about 10% mix of studios, 40% 1 bedrooms, 37% 2 bedrooms, 13% 3. Average asking rent would be $1,733, which is $166 a square foot. That is about 15% less than the market. So we're producing a product that's going to be also affordable relative to the market. We're going to have 4 quadrants of retail on the property, first floors, community amenities. This is complete Class A property with top level amenities here. More information on the park. That's going to be a significant value add for us and our property. And as far as comparables, I said there's within a 30-minute drive, the average rent right now went from $1.75 a square foot to $2.06. These are some comparables that sold recently. You have a 4.3% cap rate, 4% and 3.2. So we believe the 5% is a good number to be at. Rents 190, 175, 161 a square foot, and that was 8 months ago, so they've increased. So ours is lower than the market. We expect to start construction, breaking ground in June, and be fully stabilized by October 2025. Our project is $78 million project. Our group is putting 45% of the equity in. Total stabilized rental revenue is 6.9. Expenses 2.39. Expected exit 44.397. Waterfall is straight 40-60, 40% to us, 60% to our limited partner investors, who would be putting 50 to 55% of the equity. So we have a big stake in the project. We have a 10% preferred that goes directly to investors, and that would accumulate. And as far as our partners, Lincoln Property Management would be our property management company, obviously second largest one in the country. Winter Park Construction would be the general contractor. They are the biggest multifamily builder locally. And how to reach me. This is for both the companies, Engel Volkers, Orlando Downtown, the Radix Soft Group, and we have our contact info.
Outstanding.
Yeah.
Thank you, Pedro. Is it?
Yeah, you're welcome.
Outstanding. All right, now let's do our poll. Now, first question up. How do you rate this deal? Let's launch. Go ahead, please do. Five, 4, 3, 2, 1. I get last ones in. All right, and poll now. Would you invest in this deal? 1 to 10. How likely to invest in this deal? Let's go. How likely to invest in this deal? Right. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. All right. Jillian, you ready?
I am. Can you guys hear me okay? I'm in my car now.
I see that. I see that. Is that Tesla? You're not driving with your hands now? It's hands free?
No. I had to take my son to Boy Scouts. Okay. So again, I'm going to actually divide my comments up into presentation and then the property itself. The presentation has a lot of potential, but frankly, there wasn't enough of a story there. One of the things you said is, as we know, Florida is one of the fastest growing markets. Well, no, we don't know. We're the audience. You're supposed to educate us. So please tell me, what this really means and where these people are coming from and how they're getting there and why they're coming there. And you did touch on some of those things you said about taxes, but the first, 3 minutes you spent telling us people's resumes and, things of that nature. So, don't start with that. Tell me, again, start with the why. Tell me why we're doing this. Why are we building Class A buildings in this area? Why a Class A building is needed, et cetera. Which brings me to my second point, which is I live relatively close to a Frito-Lay factory, believe it or not. Those people aren't living in Class A units. I would not emphasize that. I'd emphasize the medical growth, not the Frito-Lay factory. And not to mention, I wouldn't want to live in a Class A building near a Frito-Lay factory, frankly. There is the Frito-Lay factory near us, it's all industrial. There's a gym there, there's a self-storage facility, and the rest is all industrial buildings. So that to me was not helpful to your presentation. That's all I have.
All righty, thank you.
Thank you, ma'am. George, you there?
I'm here.
All right, go ahead.
All right. I'll piggyback off that last point Jillian had. I agree. I had here written Frito-Lay and PepsiCo and $18 to $20 an hour. I don't think that's a selling point. They're not going to be living in that Class A. average rent of $1,733. If I do the math, at $20 an hour, you take their salary, I mean, at max, they're gonna be paying maybe $1,200 where they rent. So stick to the medical, and I think there was a couple other companies that were mentioned that had higher salaries. 5-year term, is that correct?
Yes, it's, we believe we'll exit within the 4 to 5 year range.
Okay, but the returns are all 5 years.
Correct, yes.
You know, on paper, the numbers look great as far as the returns. The cap rate at a 5, I mean, I think that's conservative in the location. What's the LP GP structure?
Our group is putting in 45% of the equity, and we are attaining, it's a flat 40%, and the LPs attain a 10% preferred, and then obviously it's 100% of the 10% preferred, and then it just goes into the 40-60 split.
Okay, 10% preferred, and then it goes to 40 GPs, 60 LPs.
Correct.
Developer fee?
Developer fee is 2%.
Is it being put back into the deal?
No, that will not be put back into the deal.
No, so this 45% that the GPs are putting into the deal is minus fees? Or not including fees?
That's not including fees.
Okay. That's not bad. It's pretty good. Speaking of the GPs, so who's the main sponsor here? Is it GFI or is it your?
Yeah, GFI is the main sponsor.
Okay. So what is your guys' role? Is it mainly the equity, or are you?
No, well, so we brought the project to market, and we don't have the level of experience as GFI does. So GFI is essentially taking lead on the development side, but we are 50-50 JV partners.
Okay. Fair enough. What phase? I must have missed this, but is the land already purchased, or?
Yeah, so we are closing on the land in 2 months. We actually went under contract a year ago, but the seller has quite a bit of things to meet in order for us to close. And they're towards their benefit because he's essentially providing almost a pad ready site. They're seller's taking care of the offsite retention and clearing the land and bringing utilities up to our site. And then we take care of our site. So they should, once we close on the land, they start that work, and we should be submitting for permits in 2 months, about a month and a half, and should be ready to go in June. All the other entitlements have been taken care of.
Okay, so is this equity raise part of the land purchase or no?
No, we're gonna acquire the land. The land is $5 million. So our partners are putting 2.5, we're putting 2.5. And we already have $1 million into the deal too. So it's actually investment's gonna be closer to 50%.
What's the median household income in that area?
71,200.
How much?
71,200.
Okay.
All right. You good, George?
Good.
All right, good deal. Irish Kevin, you up?
Yes, sir. Pedro, great presentation within the time frame there.
Thank you, sir.
I know you're under the gun. My question is more like geared towards the property itself. You know, with the size of the land that's down there right now in those certain areas of Florida, is there a reason why, like I see the breakdown of the units, it's like 324. Is there a reason why like 50% of them, like one bedrooms with studios, couldn't you make that like a different ratio? So you get
Yes.
more income?
Yes, no, you're definitely right. In the market, what we've seen with comparables is there's a very high demand for studios, but comparables are about 10%, and one bedrooms are definitely the main driver. And we believe obviously it's because the cost of living has increased so much, and that's gonna have a relatively lower monthly payment for tenants, not per square foot. So that's why there's been so much demand on that side. We are doing some changes to the 3 bedrooms. They're going to be smaller, but yeah, it's based on the market.
Yeah, because I'm looking at 3 bedrooms. It was only like 44 units, right?
Right.
So that's like 13% of the whole project.
Mm-hmm. Yeah, that's pretty much what the market has demanded now. It's possible that we increase 3 bedrooms if we make them smaller, and obviously it's smaller monthly for tenants. So it's a very likely option. We would increase by a little bit, but not more than 20% in this market.
Okay, now that's Sunreal. Is there a stop right there at the property?
Yes, it is. Yeah, we're directly beside it where you can walk to the stop.
Okay, because I'm just trying to figure out if like that area is like auto dependent as far as the tenants go.
Mm-hmm. Part of the what?
What was the what was the parking as far as how much parking for it looks like it was pretty tight.
The parking for our site is 408, which is about 75% of parking ratio. So Osceola County in this site, so this is a new city, the new other mega city coming up, which is Sunray City. So some of the incentives are, they've reduced some of the parking. They can go even to 50%, but we'll keep it at 75 due to the market. They're also, in Osceola County, impact fees are quite significant, and they're cutting off 50% of our impact fees, saving about $4,000 per unit. That's another benefit. Plus, we should have about $1 million in some tax credits, and plus the $554,000 from the development as far as putting in the roads, getting that refund back.
Okay. No, as far
Hey,
as
Pedro, if you need me to translate the Boston accent, I can do that for you next time.
Oh, good.
Yeah.
when we're talking about parking. What are we talking about? Parking.
I knew what you were talking about.
Yeah.
All right, Charles, you ready, Charles?
That's why Charles is here tonight.
Exactly. I'm a translator. So, all right, listen, I'm not going to add that much, only that, don't listen to what my fellow sharks are talking about, Pedro. You put me in a Class A property next to a Frito-Lay factory and a PepsiCo plant, and I've died and gone to heaven, okay? So I think you'll be fine there. This is a beautiful property, beautiful deal. You guys have got it, very, very slick. I don't think you'd have any trouble getting this thing funded and getting this thing built. There's a lot of money sitting on the sidelines looking for deals like this. I just don't like Florida at this time. I just think it's overbuilt. I think there's a you're pushing the rents. I mean, I'm looking right here at one of your competitors, Dan Hanford's deal. The market rents are around 1,700, which is about what you were saying. I think was what you're going for. And he's pushing at 1826, and at some point, I just think the market is too hot. But I don't think you're gonna have any problem. It's a beautiful property, but it's just not. I'm looking to chase Warren Buffett, not to So that's my take on it. It was a nice presentation.
Thank you.
Yeah,
No,
I think you did a great job. It went from that to at first we had 150 slides at first.
Right. Yeah.
So if y'all want a full slide deck, feel free to log in. Remember there, you can see the full slide deck of 150 slides. You'll see it there.
Yeah. But
Pedro, you got a couple of questions in the chat if you want to address those real quick.
Sure. I was going to say, Charles, I agree, which is why we don't acquire stabilized assets. I mean, institutions can do it at cap rates that are, 3.5. It's crazy.
I know.
Which is why that site for us made sense, because we should be about 20% under the market as far as rents. And there's no direct competitor 8 miles, and there's so much development, but it's really hard to find somewhere to develop a multifamily asset in Florida because I have the same concerns. So,
But the thing is that's where, if it's the value add and the ground up development, that's, where the money's going right now. That's, otherwise, like some of these deals I just quoted to you, these guys are paying top price, top retail at the height of the market. I think they're crazy.
yep. Well, I have a value add for you next time.
Okay.
Outstanding.
Which I can buy at 5 a forward contract. Is that it?
Yeah. Yeah, I went, that's,
I think Alex said I'm about to break even occupation point now. Or now I want to stabilize. A couple things.
yeah, I don't,
All right, I guess not.
yeah, they weren't,
All right. All right,
there
so we'll
was
wrap these things
one
up. So
on-
everybody, you have his contact information there. The next portion, thank you all for coming. The next portion is our networking session. We're doing breakout rooms. Now, I'm gonna let you know the recordings and slides are in the members area. Feel free to do that. I also put the contact list as well. You contact people on their deals, reach out to them individually. And here we go with the breakout rooms. You can choose your rooms. So I may assign you to get things started, but feel free to move around in your room. Okay, let's do this.
Cornelius, everyone's gonna want to be in my room.
I
they
noticed
are.
that. So
It's,
that's
it's
why
just
I'm
the way
trying to
it
assign
is.
people first.
Yeah.
All right,
Well, my brother's here. Put my brother in my room.
open our rooms. Okay.
As soon as Charles said that, 30 people just dropped out.
Hey, Kevin, you obviously didn't get the memo. We don't wear ties on this show because Jorge doesn't own one. So, so
Not one.
He's still in his working gear.
he is. He is. Not that you'd know what workout gear looks like.
Hey, I said working, not workout.
Oh, working.
I used to be a landlord.
Yeah. All right, what are we doing here? Are you putting us in rooms, Cornelius? or
Yeah,
you
I'm
just-
getting started, but you can move after you get in the room. So
oh,
everybody.
once you're in the
last
room,
time-
I see. Yeah, yeah.
Yeah, so you can feel free to move afterwards. So or move whenever you get a chance. I'm just throwing people in rooms right now.
Okay.
So or just find your room.
In the room.
Where's the room? I don't see where the rooms are.
All right, hold on.
I got a screen now, says